Right, so what I want us to do now, actually I said 6.2, but I want us to do 6.3. My bad, I want us to do 6.3. Okay. And 6.3, there, if you look at the required, they say prepare a detailed statement of members' net investment, show the balances and the movements as well as the respective percentage interest for the members for the year ended 31 May 2005. Okay, remember, that's the same as saying the respective shares, right? The shares in the for the members, should I say? Okay. All right. So let's get to that. So this is what it basically looks like. I hope you guys can all see. Now, up top here is what you have in terms of the. Let me try and just. I can't really zoom in here because maybe I can to some degree. Okay, so there you can see relative interest. Okay, and there you can see right at the end over here, you can see 100%. Okay. So here you've got one member, another member, third member, fourth member. Does that make sense? Okay. And in these blocks, so we then would put the percentage. So if we look here quickly at 6.3, so that's the first thing they want us to do. And then the second bit is prepare the note to the financial statements regarding transactions with members on 31 May 2005. Okay, fine, no problem. So here, when we go into the question, the CC was registered on 1 June 2007. The founding statements of the CC sets out the following: nature of business, investment, and portfolio management. Okay. Then names of the members, their interests and contributions. So there we have CJ, we have RS, and we have PM. Okay. So now there you can see the interest. The interest is 60% for CJ. Okay, so we put 60 over here. Can you see where I'm putting the percentage there? Then for the next shareholder or member, 30% for RS. And then finally, for Josiah there, we have 10%. Okay, all right. So that's how things started, okay? We then move on. They also told us that there was contributions, 60,000. Okay, so here we go to members' contributions. Can you see that where I am? And we plug in 60,000 for Surrey. Okay, and we know for more, there it was 40,000 contributions. We're on question 6.3. And then for Josiah, his contribution was 30,000 services. Here we go. All right. Then the accounting dates, 31 May. Okay. Interest on loans to and from members is payable or receivable at 14% per annum on 31 May annually. Okay. The following trial balance of the closed corporation was available on 31 May 2004. Okay. So we have retained earnings of 30,000. Okay. And that retained earnings of 30,000, it needs to be split up between the members. Okay. So in order to then establish how much does each of these guys have in terms of retained earnings, we obviously then need to say, okay, what is 60% of 60% of 30,000? And I think I have the calculation here just to save us some time because I knew we'd be pressed. So here you can see I did the calculation, and that's 18,000. So here we're going to put 18,000 because remember, Surrey has 60% of the business, all right, or interest in the business. So that's where that 18,000 is coming. If we go to more has how much? What's his interest rate? Somebody tell me, what's his interest rate? It's 30%, okay? Or should I say interest in the business? Because then we'll start really thinking interest rates for loans or something, okay? So 30,000 times then, that's 30%, all right? We get what? Did I write it down? Yes, I did. 9,000, okay? 9,000, okay? Then for Josiah, he has 10%, so that's 3,000 there, okay? Then at this point, we don't have any loans to members or loans from members at that point. So obviously, that's fine. We can leave that as is. Okay. Actually, I lie. We do have other information. 25,000. Yes, 25,000 loan from RS More. Okay, so we need to go to More, and we go to loan. So that was loan from member. So we go to loan from member. All right. And then we have to insert that information right there. 25,000, okay? And remember, we're doing the books of the company, not the books of the CC members, okay? So this is money that's coming in the business. A loan that is coming from a member is money coming into the business, okay? Then if we go below that, we have the mortgage bond. That information we don't need for what we're doing right now. Loan to CJ, 15,000. A loan to a member is money leaving the business. So that's why it's a negative there. So here we're going to say negative 15,000. Okay, and there you can see it's in brackets. Okay. Now, all this stuff here that we've just inserted, when you add them up, you'll get the total of 63,000. When you add 40,000 plus 9,000 plus 25,000, you get the 74,000. When you add 30,000 plus 3,000, you get the 33,000. Okay. So we have dealt with those balances. Okay. So I just left in that beginning balance. All right. Just to save us some time. Okay. Then we move on now to the transactions which we have here. There. It says, with regard to the financial year ending 31 May 2005, the following information was available. Okay. On 31 July 2004, Moore increased his loan to the CC with another 15,000. Okay. Okay. So this is money coming in. This loan is redeemable 31 July 2007. We're obviously doing this for the financial year ending 31 May 2005. So we're not concerned with that redemption in 2007. Okay, so take note of that. That's unnecessary information for what we're doing. So we go to More. It's More, right? Yes. His loan to the CC. Yes. So that's money coming in. And we say 15,000. Okay. Now, guys, forgive me. These things are not going to be like aligned per se, but again, here you can see, here's the 15,000. Okay, there's just a delay in the projector, but you'll see it now. Here's the 15,000, and can you see, this is the totals column, which I've just left there. Okay, so that's where those amounts are coming from. Every row, we say, okay, so what? That is the total. Right, cool. Then the next transaction, on 13 August, Surrey withdrew 10,000 of his members' contributions. Okay. So that's a contribution repaid. Okay. Contribution repaid. He withdrew 10,000. So here in brackets, remember this is money leaving us. Whenever money is leaving us, we put it in brackets. Okay. Withdrew 10,000. Okay. Then we move on to the next one. On 31 August, Josiah resigned as a member of the CC. The CC bought the contribution and paid him the full amount due. Okay, can you now see now? This is a practical application of what we did earlier. Okay, now what's happening here? We need to split, who's this? Josiah's shares between the two members that remain. Okay, so first things first, we say, okay, Josiah had 10%. Okay, so again, just in the interest of time, I've left the calculations here. I'm going to highlight them in yellow so you guys can see the calculation I'm talking about. Can you see here? We said 60 because what's his name? Surrey has 60% of this business. Okay, so we know that also what's this? Moore has 30% of this business. So we say, okay, 60 divided by 90 times the 10%, since this guy is resigning and leaving, we get 6.66. Okay, then, or you can say 6.67. Eventually we're going to round it off, but anyway, 30% divided by 90% times 10%, we get 3.33. Okay, cool. Now that we have that, we then come down here to the relative interest section and we say, so Surey's new interest in the business is then 6.6667. Okay, I'm just checking, did they round off to the nearest? Okay, no, they didn't. Okay, and then here it's obviously going to be 33.33. Okay, right. And can you see again, when we add up all the columns in 2, we get 100%. Make sense? Okay, right. Then we move on. No, we don't move on. There's still work that we need to do. Remember, the business has to pay out Josiah's contribution and his retained earnings. So here, contribution, you just write 31 August, contribution repaid. All right, what was his contribution? His contribution was 30,000. So here we plug in that 30,000. Okay, and then we also know that his retained earnings that was owed to him was 3,000. Okay. Are you seeing now the application of what we were doing with the examples? Okay, right. Again, guys, if it's flying over your head a bit, don't worry. This is why I'm recording this stuff so that you can go over it in your own time at your own pace. Okay. Right. So we've dealt with the resignation. Now we can move on. On 1 October 2004, Moore bought 10% of Surey's interest in the CC for 12,000. Can you see what I was telling you about? Moore bought 10% of Surey's interest. Okay. 10% of Surey's interest, not 10% of the CC's. So this is not 10% of the CC. It's 10% of Surey's. So we then say, what is 10% of Surey's interest? Did I do the calculation here? Okay, does not seem I did. Okay, so let me just show you quickly. We are then saying, I'm just going to put 0.10 times Surey's interest, we know is 66.67. Okay, which will obviously then give you 66.67. Okay, that's how much he's transferring over to Moore. So what is that then going to look like for us? We're then going to say, okay, that 66.67 minus this 6.67 will obviously leave us at 60%. That's the new interest for Surey. Then we go to Moore. We're going to add that 6.67 to his 33.33, which is going to give us 40%. Everybody with me? We happy? Okay, great. Now that we've done that, we then need to go on to say, okay, cool. We also know that whenever we do an internal transfer, we're going to need to transfer Surey's contribution over to Moore and also some of his retained earnings to Moore. Okay, so we have to calculate what is 6.67% of his contributions. What is 6.67% of his retained earnings? Okay, Right. So here, it's going to be a negative here. When you do that calculation, you'll see that it is 5,000 in terms of the contributions. I'm trying to see, did I do the calculation here somewhere? I'm trying to save time, but at the same time, I want you guys to see what I'm talking about. So please punch it in your calculators. Say 0.0667 times, what is this contribution here? 60,000. What do you get? 4,002. What do you get? You're getting the same thing. 4,002. Why is... Okay, I'm just trying to see now why they have a different amount here. Oh, I see the mistake that we made here. Remember, we repaid Suray 10,000 of his contribution. So we're actually supposed to say 60,000 minus 10,000, which gives us 5,000. And then we're supposed to say 10% of that. 10% of that. Which gives us the 5,000, which I have there. Does that make sense now? Okay. Kind of. I know where your confusion is coming. Ask. Why are we using 10% and not 6.67? Excellent. Remember, that 6.67 is in relation to what is this 10% in relation to the whole company. Because remember, a company is made up of 100%. So here we know that whatever adjustments we make needs to add up to 100%. Does that make sense? But when we were transferring between them, we were saying he's going to have 10% of this man's shares. Does that make sense? So we're then saying, okay, 10% of this man's capital contribution is also going to be transferred over. 10% of his retained earnings is also going to be transferred over. Okay. Remember also when we were doing the example, what did we say? We said, what is 20% of the retained earnings? Because I remember there was, I think it was A and B that was transferred. So we ended up saying 20% of 5,000 equals 1,000. Remember that? We said 20% of, I'm now forgetting the retained earnings that we had for that illustration there. So that's what's going on over there. So the only reason we are calculating that 6.67% is to say, how do we adjust those interests up top so we can, at this juncture, actually see who owns what in the actual CC. Are we good? Okay. It'll sync with time as well. Okay. As you saw there, it also threw me off. That's two. Yeah. So anyway, here 10% then of the retained earnings is obviously going to then give you 1.8. Okay. All right. And then obviously when we go now to more, with more we're adding what we've subtracted from Suray. So here 5,000 and here 1,800 retained earnings. Okay. All right. Okay, so we dealt with that one. Then we move on to the 15th. On the 15th, it says 15 December 2004, Suray made a further members contribution in the form of a vehicle The value of the contribution was set at 22,000. Okay. So yes, here we look at it as if somebody has made a capital contribution. It's only that it was an asset that was made, that was contributed instead of hard cash. So then we just say contribution made. Sorry, so I know it seems like it's in retained earnings, but it's actually for this contribution made. Okay. Okay, then we move on to the next one. On 1 January 2005, TP Hewitt bought 20% interest in the CC by depositing 18,000 into the CC's bank account. Okay, so here obviously contributions is going to change for Hewitt. Well, let's not say change, because this is his first encounter with the business. Okay, so we've recorded that 18,000, his contribution, but again, remember he's got 20% in the CC. So both these members, based on what their interest is going to 20% of whatever Surrey has is going to be transferred over to Hewitt, and 20% of whatever more the interest in the business is going to be transferred. So when we look at that, so here you can see the calculation. So we're saying 20% of 60% will give us 12%. Okay, so 12% is coming from Surrey, and then we're saying 20% of 40% is going to give us 8%. Okay, so, and here you can see the calculation. So I'm saying 60% minus 12%. That's the new percentage that we're going to have for Surrey. So we come over here under 4, and then we say he's going to have now 48%. That's his new interest or share of the business. Then here we said 40% minus 8% leaves us with 32. For more, all right, here I should actually be putting dashes or zeros, because what am I saying? This person has resigned. They've left the business. They're no longer with us. Okay, right. And then here, obviously, it's going to be a dash, and it's going to be a dash here as well, and then a dash here, and then finally, this person has how much? 20%. Okay. All right. So there, actually, I should have been putting percentages, but yeah. Oh well, we're here now. Okay. Now remember, retained earnings also needs to be adjusted. So we need to be saying, okay, what is 20% of the retained earnings for Surrey? And did I do that calculation here? Yes. So here you can see I said 20% of 9,000 plus 1.8. Okay. This is actually the calculation for more. Because can you see here for more, he has 9,000 over here, right? And then he got this 1.8 from Surrey, because remember they had their internal transfer, okay, which then gives us this 2.1. So for more, we're going to be deducting this 2,160, all right, and that we are going to also be transferring over to Hewitt. Okay, but I think I did that probably in one go. Okay, then where's my calculation for more? For Surrey. For Surrey, we're saying, okay, we have the retained earnings of 18,000, but that 18,000, we know we're deducting 1,800. Okay. Oh, here's the calculation right here. We're deducting that 1,800. Okay. And then we're saying 20% of whatever remains. And then we have this 3,240. So here we put in that 3,240. Okay. When you add that up, you obviously then get this total of 5,400. So I'm now just trying to think where to put it. Let me put it over here. 5,400, 240, sorry. Okay. And that is now Hewitt's So I see it's not here for some reason. 5240. We need to have that in there as well. All right. So again, there you're seeing a practical implication of what we're doing with the examples. Okay, everybody happy so far? Okay. Then on 30 April 2005, you had borrowed 6,000 from the CC. The loan is redeemable on 31 March 2006. Okay, so this is a loan to member. So loan to member. Okay, then obviously that's money leaving the business. So we put that in brackets. Okay, and you plug in that 6,000 there. Move on to the next. On 1 May 2005, Surrey redeemed the loan he made from the CC. Okay. Redeemed the loan. Okay. So let's see here. Surrey redeemed the loan. So here you can see the loan to member there was 15,000 that he was owing. So when we say redeemed, it means that obviously he's paid back. Okay. So here we're putting a positive 15,000, or in other words, a 15,000 without brackets, because it's money coming to the business. Okay, and there you can see it's in line with this loan to members redeemed. Okay. And we're not too picky about what you say here, but I need to see contributions made or contribution introduced, retained earnings. You know, the lingo must be across the same lines. All right, must be clear that this guy or this lady knows exactly what's going on. Okay, then what else? Last one there, it says on 25 May, land and buildings were revalued to 200,000. So if something has been revalued, it means that its price has either gone up or it's gone down. So we need to ask ourselves, what was the price before this land and buildings was revalued? Somebody tell me. 150. Thank you so much, sir. So has the price gone up or down? It's gone up. So what are they trying to tell us? What they're basically telling us is that the value of our asset, that being land and buildings, has increased. Now, if assets increase, how does that affect our books? Remember, owner's equity is equals to assets minus liabilities. Yes, 100%. So that means that our owner's equity has also increased. Can you see that? Because our assets have increased. Okay, so we then come down here and we say, okay, cool, that's awesome. We have 200,000, okay, that are landed. But now, obviously, we say, okay, what was the revaluation? How does this affect? So we say 200 minus the 150, there's 50,000. But now we need to split this between the partners according to their interest or shareholding in the business. Does that make sense? So we know that with Surrey, he's got 48%. Okay, so here you can see my calculation. 48% of 50,000 gives you 24,000. So here we're going to say 24,000. Okay. Then for more, how much does he have? He has 32% of the business. So we're saying 32% of 50,000. You can see the calculation here. You get 16,000. Okay, and then Josiah is no longer with us, but Hewitt is with us, and he owns 20% of the business. So 20% of 50,000, you get 10,000. Okay, so we're plugging in 10,000 over there. Okay, right, perfect. Perfect. And here, I don't know why I put a star. Should be just putting a 50,000 here in the totals as well. Oh, it is actually there. It's just not in line. Let's just undo that and maybe just try. Ooh, maybe I should have left that alone. Okay. Right. Okay. Cool. So let's move on. Flip the page. Oh, we actually have two more transactions. Retained earnings at the end of the financial year amounts to 127,000. It was decided to distribute 52,000 to members at the end of the financial year. Okay, cool. Then we go on. It says, according to an association agreement, each member is to receive a salary of 1,500 per month while he or she is still a member. Okay, that's for transactions between members. So we'll leave that alone for now. Okay. So here, the reason why they're telling us this information, they're telling us retained earnings was 127,000. Can you notice here they did not tell us what our profits were? Usually what happens is we will say we made profits of 250,000. Okay. Of those profits, only 52,000 is going to be distributed to members. Remember, as owners of the business, we're entitled to the whole 200,000. But we can agree to say, no, let's retain some money for, further the business. But we're entitled to all of it. But here they didn't tell us how much our profits are. So we want to know first, before we actually distribute anything, we want to know what is our profits before tax. Did they give us the tax rate here or whatever? Or should we say profits after tax? Sorry, I didn't read that right. We want to know what is our profits before, after tax. So, right, now we have to do some algebra. Okay, we have to do some algebra, and how we then do it is we say, okay, we know that 127,000 is retained earnings. Okay, so if you look, I've got my cursor there. I put down the 127,000, and then of this, I know at the beginning of the year we have 30,000 retained earnings already. Okay, so I'm removing of that 100, and remember, because this 127,000 is the retained earnings I have at the end of this financial period. So already in there, I know, because at the beginning I had 30,000. That's why it's a negative. Does that make sense? We're together. Then we say, okay, of that, I also know that there was a 3,000. Remember, there's a 3,000 that we removed. Or that we paid over to the guy who left, who resigned. Okay? What's his name? Yeah, Josiah, 100%. Okay? So we're kind of adding that back to establish how much we actually had. Okay? So then, after that, we say, okay, we then have this 52,000 that we know we're also going to distribute. Okay? So we're adding all these things together to find out what was our total profit that we made for the year. Okay. Everybody now happy with how we build this case here. Okay, right. Then we say to ourselves, okay, now we know the total amount of profit. We come down here. This is the profit after tax. Okay, so this is where why I put a star here. So remember, we need to plug this in. This is the total profit after tax. But again, we then need to quickly see how much is each of these members entitled to. So if you calculate 20% of 152,000, you'll see that it should be 30,400. Okay, so that's how much this guy is entitled to. What's his name? Hewitt. Then we say 32% belongs to what's his name? Moore, and that should give you 48,640. Okay, and then for what's his name? This last guy, Suray, He owns, I think it was 48% of the business, yeah? 48%. 48% of 152,000 will give you 72, sorry, not 78, 72,960. Okay? But then remember again, we did say we are only distributing 52,000. We're not distributing this whole profit. So since we're only distributing 52,000, we say of this 52,000, 48% of 52,000, you get 24,960. 32% of 52,000, you get 16,680. And then obviously 30% of that 52,000, you get the 10,240 that we're distributing over. And can you see that those are in brackets? Why? Because this profit that we're distributing is leaving the business. It's money that we no longer have. Can you see? So that's why it's in brackets again. Okay. Now, why this part is so important is because when you come down here, can you see again, we're calculating the balances at the end of the year for each of the members. Okay. And this I just left. All right. But you guys would have to calculate these things. So we then come and we say, what is the members' contributions after all these movements? Okay, because remember, this guy, he sold some shares over, but initially he had 63,000. Okay, then we know we repaid him 10,000, so that dropped then. Yeah, he had 60,000. Sorry, member contribution 60,000 minus 10,000. He now has 50,000. Then he sold some of his contribution or his interest in the business, so minus 5,000. He now has 45,000. Okay. But then at some point he contributed a vehicle plus 22,000. Okay, so 45,000 plus 22,000. That's how we're now arriving at 67. Can you see that? Then the next line, we revalued. All right, we had a revalued surplus. Okay, in other words, value increased of this thing. That's how we're getting the 24, because remember we calculated it here. So it's just copy and paste. Then we have, what is this? Retained earnings. Here we have, remember we have the net profit of 72,000, okay, 960. Then we're deducting it from the 24,000, because remember we said this profit is due to him, but we're not paying all of it out. Then minus this 24. That's how we're getting a certain amount. That's not all the retained earnings, by the way. We get a difference there. There you should probably have minus. You should have about 40 something, if I'm not mistaken. Yeah, 40 something, 48 something like that, 46 something like that. Yeah, no, I think 48 somewhere there. So that 48 then plus whatever retained earnings he still has in the business. Remember, he had retained earnings of 18,000 minus 1,800 minus the other 3,240 that we had to transfer over to Hewitt. Okay, then we'll lead you add those all up, then you get to a 60,000. Okay, now when you've done that, you add up all of these, you'll get to 151,960, and that's his new balance. And it's the same process for all the others. Does that make sense? Okay, awesome stuff. Right, now this next bit is the last bit, is the easy bit. I'm actually not going to what's this, because I see we're running out of time. I see the guys are sitting out there. I don't want to, and I don't want us to do this in the next session because it's just a little bit, but I'm going to explain it. I'm just going to explain it. Just give it a second. Okay, so this is now, we've now finished the net investment of the members. We finished part A of the question. We're now dealing with part B, which is the easy. Part B, we're saying, what are the transactions that we had with our members? What's going on now? This is what I want to do. Yes. Okay, now let me zoom in here nicely so you guys can see clearly. Okay. Yeah. All right. Everybody can see? Okay. Yeah, everything is captured. So transaction with members. We had loans to members and members also loaned money to us. Okay, so first things first, we want to say, okay, cool. What was the interest received as a result of the loans that we made to members? Okay, so we had 6,000 that we gave to Hewitt, all right, the guy who just joined, and that was only for 1 month, okay, right, before the end of our financial year. Okay, so that's 70 Rand that Hewitt must pay to the business. Okay, then we had a loan to Sure, but remember he paid off his loan. So I don't remember when exactly that ended, okay, but we obviously need to also proportion it. Okay, so instead of the full year, we obviously stopped it at that point where he paid. Okay, so that was for 11 months. Okay, now we've been playing with depreciation, so I'm sure we know how to apportion, or we should at least. Okay, so 11 months, 11 over 12, then times the interest rate. Remember, they said 14% for all loans, whether it's a loan received or a loan that was given to a member. And then that's how we're getting the 1.925. We're going to do another exercise, 6.2. We'll do that the next time we link up. And that's how we're getting the interest that Sure needs to pay to us. Okay? Sure, fine. But there's also interest that we need to pay over to Moore, because remember, Moore gave a loan to the CC. Okay? So we then say, how much was that loan? That loan was, we had 2 loans actually from him. No. Yes, I'm actually right. We did have. What's going on? Where are we getting this 3,500 from? Oh, yes, we did have 2 loans. We had the 25,000. I was only seeing this. I couldn't see this 25,000. So there's the 25,000 that we had at the beginning of the year. And then there's a 15,000 that we got at a later point. Okay? So this is for the full year. So we're charging the interest there. We get 3.5. Then the one that we got later, we're saying, okay, it wasn't for the full year. We need to apportion it. Times 14%, we get 1.750. We add those two together. We now know the total. Can you see it's money leaving us? That's why we put it in brackets. Boom. There we go. Sharp. Then remember, there's salaries. And remember, they said 1,500. That was the last bullet point there in the question. 1,500 to each member, all right, for every month that they're with us. So we know that Sure has been with us the whole year. So 12 times 1,500, boom. That's how much we need to pay over to him in terms of salaries. Moore has also been with us the whole year. So we're paying him same amount, 18,000. Then Josiah, he resigned, remember, but we're obviously going to pay him for the time he was with us. So we say the 1,500 times the, how many months was he with us? 3, apparently, okay? And we only owe him 4,500. And then finally we have Hewitt, who was apparently with us for 5 months, and that's how we owe him 7,500, okay? Then obviously here it's just totals at the bottom and totals here on the side. So if they ask you to do transactions with members, just remember, here we're calculating the interest that the business needs to pay over and the interest it needs to receive from loans that members received and obviously from loans it received in the case of paying, okay? And then finally, if there's salaries, we incorporate that there. Okay, but again, I thought we'd just discuss that since it's very simple and straightforward. We will do another one of these when next I see you. Okay, so guys, I don't know if you have any questions.